Consumers are spending more, with November retail sales rising 0.2%. This is one of the last big economic data points before the Federal Reserve's closely watched meeting next week. For more, we go to David Lebovitz, the global market strategist at JPMorgan Asset Management. And so, David, the consumer continues to strengthen, although this report was slightly below consensus.
Yeah, the report was a little bit below consensus, but if you look at the core measures, which we deem as being more stable and more indicative of the broader trend, the data was actually looking pretty good. In our view, it was this report and the inflation report we're getting early next week. Those were the two reports that could derail the Fed. I think we can check this one off as a win, and it still looks like all systems go for the Fed next week.
In terms of a rate hike, and we'll talk about the Fed in a moment, but we also saw an uptick in spending on restaurants and clothing, but people spent a little bit less on autos this month, right?
Yeah, and that kind of makes sense. We saw very, very strong auto spending earlier this year. I think the bottom line is that we're seeing people continue to go to restaurants, people continue to eat out. That's indicative of improving consumer sentiment, and I expect with a little bit of wage growth next year, we expect those trends to continue.
All right, now going back to the Federal Reserve for a moment, the markets are now pricing in an 83% chance of a liftoff next week. Set the stage for us in terms of what's going through Fed officials, what's going through their minds right now.
So this is a Federal Reserve which clearly wants to hike interest rates. They've said that they wanted to hike rates this year for the majority of 2015, and now we're at the end of the year. Most of us are deadline oriented. The Fed has kind of put it to the wall, and it is time for them to hike rates. If they don't, I think they run the risk of losing some of their credibility, which is something they certainly don't want to do as they embark on a tightening cycle.
All right, now some are saying this December liftoff will be, quote, one and done, and we won't see another rate hike until perhaps at least another year. Are you in that camp, or how many rate hikes do you see after the initial one?
I'm not in that camp. I think we go next week, the Fed does hike rates, and then we see somewhere between 3 and 4 rate hikes over the course of 2016. It's important to remember that this is a very dynamic process. The Fed is going to need to respond to what the economy is doing, to what inflation is doing. Our base case is, again, for 3 to 4 hikes next year, and it looks like the Fed will go as slow as possible to avoid upsetting the U.S. economy.
Well, one thing that's been happening, at least in the past several trading sessions, is the precipitous fall in oil prices, dipping below $40 a barrel. Does that worry you that perhaps the landscape for the Federal Reserve is changing a bit?
It doesn't really worry me too much. The bottom line is that lower energy prices are bad for energy companies, but they're good for consumers in countries that are net importers of energy. This should all translate to additional money in the pockets of consumers, and although that money may not be spent right away, more money in your pocket is certainly better than less money in your pocket. So we think that this is a long-term positive for the U.S. consumer, and given that the economy is based on consumption here in the States, we think that this is a positive trend.
Yeah, that's right. 2/3 of GDP is consumer spending. All right, David Lebovitz from JPMorgan Asset Management. David, thanks very much for joining us.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.